Hello folks, Steve Lentz here with Discover Options and welcome to this edition of the Market Reports. This is for the S&P 500 ending on Friday, February 10th, getting ready for Monday's open on the 13th. We have two reports for you today, the S&P 500 Condor Butterfly Timing Report for those of you advanced options traders, those traders that like to sell options premium with market neutral strategies, and then the S&P 500 Directional Likelihood Report for those of you more statistically oriented looking for some great unique market information on the S&Ps. Let's take a look at the market condition currently. As you can see here, the market is clearly blasted off, and this condition we're defining in about, four different ways here. First, price action. We have two. What the heck? Hello, Steve Lentz here with Discover Options, and welcome to this edition of the Market Reports. These will be for February 10th on a Friday, getting ready for Monday's open on the 13th. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report for those of you trading option premium collection strategies from a market neutral perspective. And then also the S&P 500 Directional Likelihood Report for those of you more statistically oriented. The market condition right now is defined as follows. Regarding price action, we have two straight upswing days, higher highs and higher lows. That all occurred when we are above the 50-day simple moving average. We are also in a stochastic situation where we are above 50 and under 90. Damn it. Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. Today we have two reports for you, all for the close on Friday, February 10th, getting ready for the open on Monday, February 13th. We have the S&P 500 Condor Butterfly Timing Report for those of you advanced options traders looking for some timing information on entry into those strategies. Also, we have the S&P 500 Directional Likelihood Report for those of you more statistically oriented wanting good information that's unique regarding the S&P 500. All right, let's look at the current market condition right now. We have two consecutive upswing days. That's the price action. That price action occurred when we are above the 50-day simple moving average. Also, that all occurred when we are between 70 and 99 with regards to the 15-3 stochastic. That is also trending upward above its 3-day moving average, %D. Okay, also, Friday's day was under, it had an ATR percent of under 0.007. Okay, so that's definitely less than what a long-term average would be. So it was a kind of a narrow range day in terms of an average true range. And so you combine all of that, and you have a very unique market condition that actually has occurred roughly 160 times since January 2000 or so. So we're going to consider this a very unique market condition. We're in overbought territory, trending upward. Okay, and then the two consecutive upswing days with the average true range of the most recent bar kind of on the low side. So all that makes for a very unique situation. Before we get going with the reports, please consider subscribing by clicking on the button, the subscribe button, and also we have a free ebook for those of you interested. Just click on the link and we'll get you to a page where you can fill out the information, and we'll get you this free ebook, Simple Steps to Options Trading Success with Jim Graham and myself. Okay, let's get to the timing report, and then we're going to get to the other report, and then we'll get into the methodology of these. But for many of you, you are veteran observers of this, and I want to make sure we just get you the actual data right away. And those of you that are brand new, you can continue listening, okay? Here we go. Since January of 2000, there have been over 4,200 daily closes of the S&P 500. Of these 4,200, of these 65% have been favorable bars for selling premium, where the actual 21-bar movement was less than the SKEW adjusted implied movement. Now we're talking about an environment for selling butters and condors, okay? Also during that time, the current condition, which I just went over with you, okay, has occurred 162 times. Now, of those 162 occurrences, 70.4 of those bars are similarly favorable for selling option premium. Okay, that implies a premium selling edge of plus 5.4%. So statistically, it's more likely than usual that the Friday's bar will end up being favorable for market neutral option premium selling. So there's your answer, folks. We're going to get into the methodology of this in just a little bit. Now let's go over to the market likelihood report. And this is where we are measuring how often price strikes volatility bands. We're basically looking at price distribution. Price distribution looking at 3 volatility bands above and above 3 above and 3 below the close. So historically, all right, price strikes the upper 5, 10, and 15-day bands 29, 23, 23%. The lower 5, 10, and 15-day bands 29.5, 29, 32%. Okay, now when you look at our current market condition, okay, now these are the non-consecutive occurrences, 119 non-consecutive occurrences. Okay, of those 119, you can see that on all 6, 3 and 3, price struck the bands less often than the baseline. Do you see that? Hence we have the red numbers here. If price exceeds Friday's high, 75 occurrences where that happened under our current market condition. You can then see here also significantly fewer. Look at that. I mean, price struck the upper bands far less often, and the lower bands far less often as well. Now, if price goes down below Friday's low, now we're getting a little bit more even with the baseline. Still, though, the upper 5-day band really doesn't get hit hardly at all. What you're looking at here, folks, is just a picture of lower than usual market volatility, especially if price exceeds Friday's high. Okay, and so if it goes down below Friday's low, then it's looking more like it could be more normal market volatility. But in general, I think we have a setup here for lower than usual market volatility, as I've described. Now, let's take a look at if we readjust the bands to the SKEW adjusted VIX width. Lots of red numbers. Price is striking the bands less often than normal. Across the board, lower market volatility with this setup. Okay, so that lends itself well to understanding that we have an edge in terms of selling premium for condors and butters. Does it mean you're going to automatically make money? Certainly not. Okay, it's just that statistically it's more likely that you will under the current market conditions than normal. Okay? All right, so now with that said, let's get to the methodology behind the reports. And so if you're brand new to this, you're going to want to stick around and watch this. It'll take us about another 10, 12 minutes or so. All right, why should you look at the Condor Butterfly Timing Report? Okay, why should you? Well, sometimes when you just intuitively think that something might work, it really may not. So here you have the market channeling along at the end of 2015, and if you run it through our algorithms, we would have discovered that there was actually a negative edge going into this, a negative edge for selling premium. What does this mean? It meant that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. Okay, that's what a negative edge meant. It meant that there was a higher than usual likelihood the market was going to be more volatile than than what was implied. In this case, the market indeed went on a down blast and got very, very volatile. Cherry-picked example, granted. However, there could be some predictability when you have the statistics staring at you in the face like this. Here's the current market condition. On this report, here's the question on the table. Is this condition a good one for selling premium through range trading? How do you answer that question? If you're a butterfly condor trader, looking at the chart, how are you going to answer that question? Is this a good environment or not? And that's what we seek to do in our methodology here. So we do 3 things. We look at the actual volatility of the market. Okay, how much the market actually moves from a close. We then observe the market move that's predicted by option prices. That's called implied volatility. Then we compare the two in retrospect, and we label bars favorable or unfavorable in hindsight, in retrospect, so that then we can do some statistical work on that. So here's actual volatility, just an example. You can take a close, you go forward 21 bars, and you ask yourself, how far did the market actually move? Real simple. Did it move up really far, down really far? What was the maximum amount that it moved at any given time? And here it clearly went down more than it went up over the course of that 21 bars. Okay, and so in this case, it actually moved down about 50 points, which turned out to be about 2.4%. And we can graph that here. And at the time, you know, if it went 2.4%, what was being implied at the time by the option prices? This is where we get into implied volatility. Okay, we look at the implied move, and the implied move at the time was 4.4%, which was higher than what actually came to pass. So this would have been a favorable bar for selling premium. The implied volatility was higher than what actually came to pass. That's good if you're selling premium through Condors and Butters, right? Okay, so what we're going to do is label the bars blue in these cases where they turned out to be favorable, and we label them red in the cases where the market moved more than what was being implied. Those were unfavorable, red and blue. Now, of course, the most recent 21 bars, we don't yet know if they're blue or red, so we just label them black. All right, now, here's what we're looking for. What percentage of the bars going back were favorable in the SPX? What's the percentage of those that turned out to be good for selling premium? Favorable. Okay, then we look at those bars that just match our current condition. Just those that match our current condition, those 162 or so. If there's a difference, okay, if we find out that all 162 of our bars that match our current condition, if all 162, okay, turned out to be unfavorable, well, would you put a Condor on if all 162 were unfavorable? Of course not. What if they were all very favorable? What if they were all blue bars and favorable? Well, you would probably load up on the Condors and Butters. So we want to just kind of see where we're at there and see if there's a big difference. So historically, as it turns out, of the 4,200, 4,300 bars going back to Jan of 2000, 65% turn out to have been blue, favorable for selling premium. Okay, not too bad. 35% of the time the market moves more than what was implied. You better be quick on your feet with your adjustments or even your exits. Okay, you better have a good plan, and we can help you out with that at Discover Options Mentoring. All right, now, of the bars that match our current condition, what percentage of those were favorable for selling premium? Well, as it turns out, okay, 70.4% were blue. Now here you can see those little green triangles. Okay, those are the bars that match our current market condition. You can see on this case we have 2 blue, 2 red. If you went all the way back, you discover that 70.4% of them turned out to have been blue, those that match our current condition with the little green diamonds. So what does that mean? It means that we have a 5.4% edge, meaning that there's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. Okay, so we have a little bit of an edge here. Hopefully that flushed out the methodology, and with that information you can make some better decisions this coming week. Let's get to the other report, the market likelihood report. Before that, make sure you know we at Discover Options offer a fantastic curriculum for you guys to get from an intermediate level to an advanced options trading level, even at the level where you can manage other people's money. We have people doing that, students, our mentors do that, and if you want to get to that level of expertise, we can get you there as fast as possible with our progressive curriculum, with homework, and with our one-on-one hand-holding sessions with our mentors. And we'll get you there if you want. Go give us a call. Check out our website, look at the curriculum. It really is fantastic. We offer a futures track and equity track for indices, ETFs, and stocks. Earnings, we have an earnings track as well for you. And if you're into overlaying your long stocks, we have covered calls and puts and collars that'll help you get to where you want to go as well. All right, here is the market likelihood report. Let's dive into these numbers and see what they mean. We have our current market condition. Here's the question on the table, folks. Since Jan of 2000, how often has this same condition occurred, and what did the market do in terms of direction and volatility? Okay, what did the market do in terms of direction and volatility? So here's the methodology here. We first have to understand the historical distribution of price. Okay, we need to know where price went, and we have a way of doing that. Then we need to know the distribution after our condition develops. Now, if the two are significantly different, well then, we want to be able to measure that and measure if there's an edge. So let's talk about distribution of price. I mean, it's more than just, well, did the price go up or down? Okay, we want to really get into get more detailed here. So we're going to talk about distribution, measuring it in terms of observing how often price touches some volatility bands that we set up. 1 standard deviation volatility bands set 5, 10, and 15 days from today's close. Okay, measured, set from the close. Okay, we use a 20-day historical vol number, and then later we'll also use a SKEW adjusted VIX number to determine the width of those bands from the close. These are normally distributed, of course. All right, so here's an example. Let's just take a little example here. Let's take the close today. You have a 10-day band, and the question here is price going to go up and hit the upper band, the upper 10-day band, or the lower 10-day 1 standard deviation band, or is it going to wobble in the middle and not hit either one of them? So in this particular case, price clearly hit the upper band, and so for that close, we record that it hit the upper band. Now next, we have a close up here. The upper 10-day band, the lower 10-day band. Price could either go up and hit the upper band, go down and hit the lower, or wobble around and not hit either. So let's see what happened. In this case, it almost went down and hit that lower band, close but no cigar. So in that particular case, we record that it hit neither band. So in terms of measuring distribution, for every close, we record whether price struck the upper and the lower 5, 10, and 15-day bands. And we keep that statistical measurement there. And here's what it looks like. Okay, out of 4,282 closes dating back to Jan of 2000, price struck the upper 5-day band 29% of the time, 29.3. It hit the upper 10-day band 23%, the upper 15-day band 23%. It hit the lower 5-day band 29.5%, the lower 10-day band 29.2%, the lower 15-day band 32% of the time. Now that's the benchmark here. This is just the benchmark for all 4,282. Now let's look at the distribution. Okay, here, this is what we have to do. We have to understand the distribution after a specific condition develops. That is our condition that we just had. And so we're going to measure the distribution at the close. Okay, what I just described, that specific market condition, the unique one, we're going to measure the distribution of those 119 non-consecutive occurrences from the close. Also, what happens out of those 119 non-consecutive occurrences of our condition? What happens if price goes above the high from Friday? What's the distribution there? What if it goes below the low of Friday? What's the distribution then? This will be helpful information for you. So of those 119 non-consecutive closes, okay, price struck the upper, look at this, the upper 5-day band only 11.8% of the time. Struck the upper 10-day band 16% of the time. These are way less than the benchmark, 29 and 23%. Okay, do you see what's happening here? Is price wobbles around in the middle, more often. Now, price on the lower bands, look at it, it did strike the lower bands about a quarter of the time rather than about 30% of the time. So we have red numbers across the whole spectrum here as of the close. So we're looking at lower market volatility in general. Does that mean the market's going to not hit any bands? Well, no. Look at it. It could still hit the bands. It hit the lower bands a quarter of the time. It hit the upper bands between 10 and 15% of the time, 10 and 16%. Okay, so it can do it. It's just simply judging from what this pattern has generated in the past, it would appear that there's a lower likelihood that it will. Okay, now let's go on to if price exceeds today's high. Okay, we similarly have lower values, lots of red numbers here. Lots of red numbers. Even look at that though. If it goes above the high, you really have some lower numbers. So, boy, the market volatility really goes down if it exceeds Monday's high. What if it exceeds Friday's low? Well, then we have the numbers more matching the baseline, and it's not such an extreme advantage for the for those that are depending on lower market volatility. The upper 5-day band really gets hit only 13% of the time. That's a lot less. What if we recast the bands using a skew adjusted VIX? VIX is always typically, much lower than the statistical. Higher than the statistical, so that the bands are going to be farther apart. They'll get struck less often here, by nature. So, even when we recast those VIX bands like this, again, lots of red numbers. Lower market volatility is likely. All right, doesn't mean it'll definitely not be volatile, but certainly there's a greater chance that it won't be as volatile as normal. Here are the volatility numbers for the market. Skew adjusted upside, skew adjusted downside VIX of 12.5. Let's keep that in mind, and let's take a look at a trading idea. Okay, let's take a look at a hedged bull put spread, keeping that 12.5 in mind. And what we do with that is we go into option view, go to that SV button there, the statistical or the standard deviation button, plug in 12.5. That takes us out here, getting a credit spread out here. This is a hedged bull put spread. Here's the bull put spread. We collect money as a standard deviation. We're going to take that credit and use it to buy an at the money bear put spread to hedge that. We still make some cash flow here. Works out to about 4% of the amount required. And when you graph this thing, what's beautiful about this is if the market goes up, you're definitely going to make some money. If it goes down, that hedge kicks in so that if at expiration, if it's short of a standard deviation on the downside, you could make 4 times what you're trying to make on the upside here. That hedge kicks in and lifts this shoulder up. That's a beautiful thing. When you look at the price or the profit area on the price chart in option view, there you go. All we need is for the market to wobble around for a little bit, and the situation in the position makes money. Good picture there. Folks, I'm Steve Lentz with Discover Options. Thank you for joining us. We'll be back next weekend. Take care. Bye-bye.